Market ups and downs can shake even the most confident investors. In this video, we'll explore how to stay calm during market volatility. Learn practical tips to manage stress, keep a long-term perspective, and make clear-headed decisions, even when the market feels unpredictable. Today, we will talk about how to stay calm during market volatility. So before we get started, make sure to hit that like button, also subscribe to my channel. Understand that volatility is normal. The first and most important thing to realize is that market volatility is completely normal. It's not a sign that the world is ending or that you should panic. Financial markets have always been unpredictable in the short term. Sharp rises and falls are part of the game. Volatility happens for many reasons: political changes, economic news, company earnings, global events, or even rumors. These short-term shocks don't necessarily change the long-term value of your investments. Over decades, markets have shown a general upward trend despite many crashes and recessions. Recognizing that volatility is the normal rhythm of investing will help you resist the urge to react impulsively. When you remind yourself that these ups and downs are expected, it becomes easier to stay calm and avoid panic selling. 2. Focus on your long-term goals. When the market drops suddenly, it's easy to get caught up in the fear of losing money. But the truth is, investing is a long-term journey. Whether you're saving for retirement, buying a house, or building wealth for your family, these goals often take years or decades to reach. Thinking about your investments with a long-term mindset helps put short-term losses in perspective. A 20% drop today doesn't mean you have lost everything. It's just part of the ride on your path to your goal. Keeping your focus on what really matters helps you avoid emotional reactions. When you remind yourself why you are investing, you build the patience to stay invested through difficult times. This mindset will serve you well during any market downturn. 3. Create a well-diversified portfolio. Diversification is one of the smartest ways to protect yourself from extreme market swings. When your money is spread across many types of investments, stocks, bonds, real estate, different industries, and even countries, you reduce the risk of a single event wiping out your portfolio. For example, if the tech sector falls sharply but energy stocks go up, your overall portfolio might stay stable. Diversification means your money is not all eggs in one basket, which lowers your stress during market drops. Knowing that your portfolio is diversified can give you peace of mind. It reassures you that the damage will be limited if one area suffers losses. This understanding helps you stay calm and trust your investment strategy. 4. Avoid checking your portfolio too often. Watching your investments constantly can make you feel anxious. Every small movement might trigger a fear reaction or false hope. This constant emotional roller coaster can lead to poor decisions, like selling low out of panic. Try limiting how often you look at your portfolio. Checking once a week or even once a month can help you avoid unnecessary stress. When you step back and stop obsessing over every daily change, you give your mind space to think clearly. This distance helps you focus on your long-term plan instead of reacting emotionally to short-term noise. 5. Have a clear investment plan. A solid investment plan is your best defense against emotional reactions during market volatility. Your plan should clearly outline your goals, risk tolerance, and how you will allocate your money. Writing down your strategy means you have something to refer back to when times get tough. It stops you from making impulsive choices based on fear or greed. If your plan says to stay invested during downturns, trust it. A well-designed plan is created to handle market ups and downs. Sticking to your plan builds confidence and helps you keep your emotions in check. 6. Remember the power of time in the market. One of the most important lessons in investing is that time in the market beats trying to time the market. Many investors lose money because they try to guess when to get in or out based on short-term price moves. Staying invested allows your money to benefit from the market's long-term growth and the compounding of returns. The longer you stay in, the more opportunity your money has to grow. Reminding yourself that investing is about patience and time can help reduce the urge to sell when markets fall. This awareness helps you remain calm and focused on the bigger picture. 7. Use market volatility as an opportunity. Volatility doesn't have to be a source of fear. It can also be a chance to buy quality investments at lower prices. When markets dip, Some stocks and funds become undervalued. If you have cash available, you can invest more and improve your potential returns over time. This requires a calm and confident mindset. Seeing market drops as buying opportunities rather than reasons to panic turns fear into advantage. Investors who act calmly during volatility often come out ahead by adding to their positions when prices are low. 8. Practice mindfulness and stress relief techniques. Investing can be stressful, especially during uncertain times. Taking care of your mental health is essential to staying calm and making good decisions. Simple activities like deep breathing, meditation, walking, or exercise can help reduce anxiety. When you feel calmer, you think more clearly. Healthy habits support your emotional well-being and help prevent impulsive investing moves driven by stress. 9. Seek professional advice when needed. Sometimes, market volatility feels overwhelming. In those moments, it's wise to seek help from a financial advisor. A professional can provide objective guidance, help you stick to your plan, and rebalance your portfolio when necessary. Talking to an expert can increase your confidence and reduce stress during market downturns. They can keep you focused on your goals and help you avoid emotional mistakes. 10. Accept what you can't control. The most powerful thing you can do during market volatility is accept that you cannot control the markets. You can't predict every crash or boom. Worrying about things outside your control wastes energy and increases anxiety. Focus instead on what you can control: your investment plan, your emotions, and your actions. This acceptance creates peace of mind and helps you stay calm, clear-headed, and ready for whatever the market brings. Understanding market volatility is just the beginning. To truly master staying calm, it helps to understand some psychological reasons why people panic during market swings. Humans are wired to react strongly to losses. This is called loss aversion, and it can push you to sell at the worst time. Knowing this natural bias allows you to prepare and resist emotional decisions. Also, consider setting up automatic investments. When money is automatically invested every month, you avoid trying to time the market. This set it and forget it approach removes emotional decision-making from the equation. What do you think of our video? Let me know in the comment section below. Before you go, please hit the like button and subscribe to my channel. Thanks for watching.